And I'm going to do this one more time. I'm going to share with you a button I'm going to use during our presentation. That is your opportunity to take advantage of some conversation we can have around three specific topics that will equip you to be able to make great decisions going forward. This is a 50-minute conversation we can schedule during the webinar today. If you see or hear anything that you like specifically and want to go deeper, feel free to hit that button, and this will register with Joella and Susan to be able to schedule a time for us. Well, I'm looking at my watch, and we're going to start tonight at 6 sharp. So welcome to all of you. I'm really excited to be with you tonight. We're going to be talking a lot about the upcoming tax storm. And so as I think about storms, just in general here in Central Florida, we have a lot of them. And I'm going to ask you a simple question. If you have the choice between simply waking up the evening or the morning after a very, very severe storm, and you see all the damage around you with zero expectation of a storm, how does that feel versus knowing 5 or 6 days or maybe even a week in advance that there are a severe storm coming through? Obviously, if we know in advance of what's happening and how we can influence that, we can go put our chairs away. We can put, maybe we lift the boat up and we put the basketball hoop away. The difference is just simply knowing about it versus completely being hit on a blind spot. And I think that's kind of where we are this year, more so than any. I believe we are really on the eve of a significant tax law change. And I'm going to walk you through that tonight and talk with you more about what do we see is coming, why is it coming, and most importantly, what can you do to control the outcome, and what options are available for you. So again, I'm going to share with you, how did we get here? Where are we? Where can we go from here? What would be the impact to taxes, and what you can do specifically to protect yourself? And as I shared earlier, as I was welcoming folks, there's opportunities for you to take advantage of what I'm sharing tonight. There's opportunities to go deeper into the conversation. Those opportunities you just need to take advantage of by clicking on this offer that is showing up on your screen. It will lead you to a little bit of input as to what is the best time for us to have a discussion, and it will allow 50 minutes for us to be able to go deeper and able to also do some really cool analysis for you that is in very good summary format that can help specific questions that we have. We have 3 of those type of reports. And then for those who stay with us until the end of our time together, I've got another very, very nice surprise for those, and an offer for you to be able to read more about what we're talking about and how you can protect yourself. So first question I have for you, and this is where I would love to have your response in the chat room. Will your taxes be lower in retirement? How would you answer that? Would you say yes to that, or would you say no to that? So do you expect your taxes to be lower in your retirement? Would you say true, or would you say false? Let me see what I'm hearing from you. If you would, please respond for me there in that chat room so I can get an idea of how you think about that. Let me see, I got some answers coming in here. I got some trues, and I got some falses that's coming in right now. So let me see. I got a false that came in here. Thank you. I got a true. I got trues and falses. They coming in. I got an F for false. I got about the same. And I got different answers. I got a false here, another false. And it's a good question. It's a great question. And you know why we have this question is because there's a certain perception. Now, first and foremost, I'm showing you a picture of a house. You have to look and see what influences your tax return now versus in the future. And some of the things that are changing just by our lives is that typically when we're in the income producing phase of our lives, when you're my age, you still have a mortgage and you got very large income tax deductions as a result of it. You have children you can still claim as dependents. But when a person retires, typically that mortgage is much, much smaller. Also, the children are not of minor age anymore. You cannot claim them as dependents. And that in itself makes quite the substantial difference between your tax rate during your growth years of your life or income earning years and your retirement years. So there's a few things that influences this. In our retirement years, we go after our hobbies, we go after the things that we would love to do, and we're more in the spending phase of our lives and less in the saving phase of our lives. So another big thing that makes a big difference is how you are saving or how you have been saving for your retirement. The most popular tools that most people use is called the 401k. People use that tool because it creates a match situation where you can earn some more money for your retirement. Well, in the retirement years, you're not necessarily contributing to the 401k. You are simply using the money that's inside that 401k. And that's a big difference between also your tax rate now and your tax rate in the future. What else influences this? A big part of this has also to do with the tax rate and where it is trending. I think, as you would see tonight, the biggest impact that you have on this tax rate situation that's increasing, for the most part, you could say is just the vote. Do I vote Republican? Do I vote Democratic? And what that would result in. But there's more controls for you that I'm going to share with you about that. So the answer, as many of you said, is pretty much it depends. It depends. Here's what I've discovered. I've been in practice 25 years. And when I remember coming into practice, we really talked about this concept a lot. And in our training and in our conversation with our clients, we warned them against the potential possibility that it might be right, might be wrong that you're in a lower tax rate situation. The ultimate answer to this, it depends upon your very unique circumstance and situation. But I mentioned this to you before, that the most popular investment vehicles that we've seen people save their money into on a day-by-day basis, when I visit with folks, I find that the majority of their money is sitting in environments that will be subject to a tax when they pull the money out. I'm going to later on share with you specific investment vehicles. In those types of investment vehicles, we are simply not saving the tax, we are just deferring it. And we're deferring it until the future. And in that future, we have a silent partner. And what we talking about here is how much a silent partner is going to be taking from us. And that's really dependent upon your tax rate at the time when you pull the money out. Here's the biggest thing. I remember my first client that I retired that came to me and said, Hilgard, he was actually angry at me, believe it or not. He was angry at me, and he was actually more angry than his CPA, because he said to me, I always thought the moment I retire, I was going to be in a much lower tax bracket. And he was kind of hitting the table, and he said, you won't believe it, but now that I'm fully retired, and I had this meeting with him 6 months after he retired, I have discovered that I'm paying more taxes now in my retirement than I ever paid during my working years. And why is that? I remember that conversation as it happened yesterday. It literally was 23 years ago. And it really stunned me because all my training came to fruition and I saw it play out right in front of my eyes. The question for you too is, when you retire, your tax bill is truly a bill, and you're trying to figure out how to minimize that. So let's think together. So where did this discussion start? Something unique happened here. A big trigger event happened about 1.5 years ago and has kind of put us in a unique situation and environment. Obviously, it's the coming out of COVID and the result of what happened due to COVID, with us and the whole economy shutting down, and the presidents, and I say presidents since we have now 2 presidents over this period of time, making responsible decisions to protect people's health, had to make decisions around the economy. Now, you can judge probably in 2 or 3 years from now whether those were responsible decisions or not, but yet they were decisions. And what happened here is these federal stimulus packages that came out. I'm counting 4 at this point in time. First package came out back in March of 2020. Pretty substantial package that President Trump signed into fruition, $2.2 trillion. Largest emergency package, stimulus package ever in the history of the United States. Back in December of 2020, another package came out, $900 billion. You could say 0.9 trillion. And then since President Biden came into office, $1.9 trillion. I know you guys are shaking your heads like I am. You know, I physically saw a picture one time of what $1 trillion looks like in the form of $100 bills. And all I can tell you, it's stacked up very, very high on a football field. It blows your mind. It is 12 zeros. 12 zeros. And lo and behold, you won't believe it, but many of you read it. Last week, our president has come up with the fourth one, about I believe it's a $2.4 trillion package that's coming forth again. We have increased as a nation our debt in a very short period of time, very, very substantially due to COVID, just absolutely substantially. That's the big difference. Here's what we all know. We all know that the Federal Reserve is dishing out money right now, left, right, and center, but there's going to be a day by which we have to pay that bill. And we all have been talking a lot about this. It is of great concern because the dollar amount is just stacking up, stacking up, stacking up. And I know many of you feel the same way most people feel, which we are putting our children in tremendous amount of debt. But it is a pressure because at some point in time, this debt has to get repaid. Now, I know you don't watch this. This is the US debt clock. It is pretty depressing. We pulled this debt clock up about 5 days ago, and we were staging at about $28.1 trillion. I think this is actually updated till today. I've looked at this, just a few minutes ago, and you can see it turn. We have 152 trillion in debt is what I just saw about 10 minutes ago. And it is clicking on so fast. It is alarming what's happening here. The second question is, where would we go from here? Could your taxes be on the way up as a result of what we just described? You have to ask yourself the question, where is our tax rate at the moment? Where have we been and where are we going? But with a 4 trillion plus increase, I would be fair to say we probably should consider expecting those rates to go up. In fact, I do believe we are on the eve of a tax code change. I jokingly have said to some of you in person, watch, it's going to come out December 27th. I don't know exactly the day it's going to come out, but I'm going to share with you some details about some of the thinking that is currently being shared in the Biden administration about what would happen when the new tax code comes out. So here's some of the details on the $1.9 trillion plan. We got some ideas of what's happening here, but at the moment, $1,400 check per taxpayer has already hit the mailboxes. We have unemployment benefits that is raised up to a $400 per week benefit, where the normal unemployment check wasn't that big. I don't know about you. Some of you are small business owners. I am stunned. We are a growing firm. We're looking to hire more folks to add to our team, but the amount of people applying for jobs right now is about a tenth of what it was about 6 months ago. And I think it has a lot to do with this unemployment benefit, as well as the stimulus check that's been hitting people's mailboxes. Then increasing minimum wage up to $15 per hour, the impact of that we can discuss probably for a good hour on. And then funding for COVID testing, vaccine programs, aid to local governments, aid to schools, child tax credits. All these things are being funded, and it costs a lot of money. Where is this going to take us is the big question. Now, here's kind of some of the summary of the thinking of President Biden and some of the details that we see is coming through at this point in time. I have them in my notes, so give me a second to page there, because I want to be able to communicate this clearly with you. We see some of the tax code changes happening very specifically in the tax rate. The highest tax bracket at the moment being 37%. It is pretty much common knowledge that President Biden is looking to raise that up to 39.6%. I'm going to show you a slide here in a second where you're going to see where we've been, comparatively speaking, over the last 100 years, and where is that 37, even 39.6 staggering up. We're looking at, this is the one that is an indirect way that we see very often in administration changes. It has to do with the amount of itemized deductions a person can claim. Another indirect way of increasing your tax rate is by either maxing out what your itemized deductions are looking like, or actually phasing it out at certain levels of income. One of the itemized deductions that most people have control over during their growth growth phase or accumulation phase of their life, as well as in their spend-down phase of life, is your charitable contributions. For $1 of charitable contribution this year, you probably would get about a 70% or 70 cents economic benefit next year, in the way that the proposed itemized deductions around charitable giving would look like. It's pretty convoluted. It's transitioning from a deduction, dollar for dollar deduction, to more of like a tax credit. But the bottom line is it will have about 70% of the impact in a creation of a deduction or lowering your taxes in next year than it would be in this year. Then there's the increase in capital gains taxes. For higher income owner, higher income tax, or higher wealthier folks, there's a substantial increase. The highest capital gains tax rate at the moment is 20%, but for folks who have incomes of above $1 million, that means taking the current capital gains rate from 20% all the way, making it equal to the highest bracket on the income tax side. So for those folks, it means basically doubling the capital gains tax, which is very, very substantial. Another big one that's going to influence folks is this concept. There's a lot of talk that Biden said that he's not going to increase any of the tax rates for any people making less than $400,000. We're seeing his accounting part, if you would, or the economic side of his administration say they don't know how he can afford to do that. So I'm not sure he's going to change the brackets or not. He might change the rates. But most of the changes is really, really, really punitive for business owners or those who are earning higher levels of income. I won't tell you that it's not going to change people below 400,000. There's sneaky ways how they do that. Again, by, for instance, changing itemized deductions or exemptions, or even reducing the standard deduction. All those things are very, very much in the cards. But here's something that's extremely punitive as well. For those folks making more than 400,000, the current payroll tax, this is not federal income tax, this is more Social Security and Medicare tax. You are subject to a Social Security tax on the first $142,000 of income that you make. Then at the moment, if you make any more money than that in wages and bonuses, you're not subject to Social Security at all. But under the new laws, there would be the same up to 400,000, and then from 400,000 on, those folks will be subject to Social Security and Medicare tax again, and that would be at a higher rate, also an increased rate, not 7.65%, but at a much higher rate, close to 10%. Very punitive to folks that are in a higher income phase of life. There's other deductions or changes like phasing out the 20% qualified business income deduction for small business owners. So if any of those who are on our call are small business owners, you're going to have to put an umbrella on, because I think the tax man is going to rain down very, very hard and very, very harsh. Then something that's very practical too, and that is estate tax. So what you'll see is they will move things around federal income tax. They'll move things around the itemized deductions in a big way. They'll move the payroll tax, which is what I'm explaining to you here, and then they will also move, most probably, two big issues around estate taxes. The first big move is, at the moment, families who have less than $23.6 million will not be subject to an estate tax. As a husband and wife, you both have $11.3 million as an estate exemption amount. They're talking about reducing that exemption amount to $3.5 million, so that the total family who transfers more than $7 million to their heirs will yet again be subject to an estate tax. And that estate tax rate also moving from 40% to 45%. Simply said, if a couple passes and they have a $10 million estate, under the current tax code, they'll pay zero estate tax. Under the new tax code, they'll pay $3 million times 45%. They will pay about $1.4 million in estate tax. Another big change is, at the moment, if you have a highly appreciable stock portfolio, or you have, say, real estate, and upon the person's death, you would be receiving a step up on cost basis. Simply said, if you bought a piece of real estate for 300,000 and you pass, and this real estate passes to your children and the current value is 500,000, the cost basis steps up to 500,000, passes to your kids, and there's no capital gains tax. Under the new code, they're talking about taking that away. So if you're not subject to the estate tax, your kids will be subject to the capital gains tax. Just another way of getting tax money. Well, folks, what my team has done is really read as much up on this topic as possible to get our arms around what I call the mirage, the trend, where things are moving. And I can see it's never popular for any politician. And they love to say that we haven't increased your taxes, but I cannot see any other way other than substantial increases for folks on their income taxes. We see it every way that I've described to you. Now, if you don't think what I'm saying to be realistic, I'm going to show you another way of looking at it. This is the debt to GDP ratio. The total debt and what we have compared to the total gross domestic product. You can say that's the production that we deliver through our economy. In the beginning of 2020, the ratio was alarming. It became alarming the first time that we actually had more outstanding debt than we had on the production. And that ratio in the beginning of 2020 was about 103%. On the picture, you see the ratio Q1 2020. After the first quarter of 2020 started raising again. If you remember that March, President Trump came out with the first tax relief, or that first economic relief package. So we went up to 108%. And where we are Q3 and where we are today is about 128 to 130%. So our debt load is substantially increased, comparatively speaking, to our outstanding debt number. Some say that you get to Greece at about 165%. So the country of Greece that failed financially, their debt to GDP ratio is about 165%. We are getting close to about 130%. At some point in time, this debt's got to get paid back. So it simply said this: the higher the ratio, the tougher it's to pay back your debt. The lower the ratio, the easier it's to pay back your debt. That's kind of where we are. Here's something true. It shouldn't be a shock, but this is our current administration saying, look, every major economist is telling me that now's not the time for me to balance the budget. Can any of you remember when last did you see a year in which our federal government came out with a balanced budget where we did not create a deficit? Go to the chat room. Let me know what you think. What was the year last that our federal government came out with a balanced budget where they actually was spending less than what they were collecting in taxes? Can anybody remember that? Let me see. Let me see what answers is coming in for me now about that. All right, I got a few answers here. I remember that to be the year in which, I got not in my lifetime, I got 1985. The last time I heard that conversation was before Obama was president, right? President Bush. That was the last time that I heard that comment. Back then, by the way, our national debt was in the 7 trillion range, just to kind of give you an idea. So it's been quite some time since we had a balanced budget. Okay, but now it's not the time that our current administration is going to get us there. So it's the continuous kicking of the can down the road. So I want you to take a look at this. Here's a unique opportunity. First, on your left-hand side, I mentioned to you earlier, I was going to show you a chart of where the highest tax rates has been in our country. And many people do not believe me if I tell them it was as high as 90%. In fact, President Reagan was a movie star during this 70% and 90% era. And when he became president, he dropped our rates down very, very substantially. It was right when President Reagan came into office. And that had a lot to do with the fact that he was doing 2 movies a year, and on his second movie, he stopped doing that as an actor because he knew he had to give 90% of his income away to the federal government. Governments are changing rates whenever they need money, and many of the times when you'll see rates went up, it's because of catastrophe. World wars has a lot to do with it. Economical collapses has a lot to do with that. But what I want to share more is good news. We have the Tax Cut and Jobs Act that came out when President Trump became president, and it is expiring in 2025. And what I want you to look at is that our tax rate today is the lowest it's been in a very, very, very long time. If you look at it, the average tax rate in America is 55%, and you can see that we had a very low tax rate. That creates an opportunity for us to have further discussion tonight. So what can you do to protect yourself? That's the big question. We know the storm is coming. What can you do? So let's talk about that. I think when you look at taxes, you can look at it 2 ways. You can look at it in the rear of your mirror, or you can look forward. You can have a micro view of your taxes. This is the time when most people look at their taxes only in the rear view mirror. It's like when you start calculating your tax bill or your refund. Well, I will suggest to you there's a different way of looking at it. We can look through different lenses, and we can look forward, actually. It's one of the most exciting things is why I am in this career. Many of you remember my story, driving to my final accounting exam and thinking with myself after 5 years, I'm not sure I want to be an accountant, because accounting to me felt at that time as just recording the past. But the beauty of what I endured the next year and a half was coming to realization that I could use my skills in especially the tax code and help people look forward by transitioning their viewpoint from recording to planning, tax recording, tax calculating to tax planning. And in there lies, I think, great opportunity for you this evening as well. So when we look at that together, forth comes tax strategies. Many of you heard me talk about the 35 concepts and strategies that we've developed. And I would say I will not take the credit on myself. It is a combination of me sitting down with some forward-thinking CPAs and tax attorneys. But as a practice, we came up with 34 strategies that can help you today to reduce your taxes this year. But what we also can talk about is tax strategies that can reduce your tax bill for years to come. And I want to share with you some of those ideas and concepts tonight. So I'm going to share with you this. Here's my offer to you again. If any of what I've said to you so far makes sense, and if you'd like to take advantage of a 50-minute conversation just to talk about income tax savings opportunities that you can have in this year to help you out next year, simply respond by clicking on that conversation opportunity to have dialogue with us. Whether you're an existing client or brand new person to listening to this webinar, I would suggest you can take advantage of that. Knowledge is power here. It can really help you reduce your taxes. I see it every single day in the way that I see people's tax returns before and after. A lot of wonderful opportunity for you all year. Well, what we ought to do is we look forward is to try to do anything in our power to reduce our tax volatility. And the first report that I will share with you is to take a look at where you are. Isn't it true that any journey that we take, a journey of 1,000 miles, always starts by knowing where you are? And the first report that I would love to help you with is to discovering where you are. This is the most amazing part for me about financial planning, if you would. I can have the same rate of return fund, let's say your favorite Vanguard fund, earning the same rate of return at 8%, but having a radically different result for you depending upon what tax bucket we are putting this account in. I can put that favorite Vanguard fund into this bucket, or this bucket. Now, what are these buckets? In the first bucket, as we grow wealth, you have to pay the taxes every single year as you grow it. In the second bucket, we can defer the growth until the time we take the money out. And in the third bucket, there is no tax on the growth. There is no tax on the growth. You heard me right. To me, the exciting part when I saw this 25 years ago was that maybe as an accountant, trained as an accountant, I have a distinct advantage because it blew my socks off that in America, you can grow wealth and pay zero tax on it. And you do that if you understand the code. So I'm going to show you a few ways how we can make that happen for you. First and foremost, what type of accounts do you have to pay income taxes on in the year in which you receive it? Here's examples. Pension income. Short-term capital gains is taxed as ordinary income. Stock dividends. Interest on your CDs. Dividends and taxable distributions from your mutual funds coming out of different brokerage accounts. All this is subject to an income tax as the money grows and as you receive the income that comes into your life. What type of investments fits into this tax deferred bucket? It's traditional IRAs, it's 401ks, 403bs, 457 plans, annuities, and saving bonds. These are all different tools that most people use, and it's deferred until you take the money out. And then what type of investment vehicles fits into this income tax-free bucket? It typically is Roth IRAs and income coming from those, municipal bonds, and properly structured life insurance policies. The life insurance industry has a unique tax code called Section 7702 that allows you to pull money out of a life insurance policy, not at the time you die, but the time that you are living. And that income stream that comes out to you is also income tax free. Here it is. I tell folks that I'm a tax chiropractic doctor. All I do every day is I crack people's tax backs and I move their investments more and more towards the tax variable side. The moment we can do that, we're going to make your wealth accumulation much more efficient. It's as simple as that. Well, the first suggestion I have for you tonight is to take advantage of a complete free tax diversification review. Here again is the offer. You just click on this little button, and if you want this, you can respond to this, and we and my team will be happy to produce one of these reports for you. What is this? This is an opportunity for us to take a look and see. This is how the report looks like. Really easy to understand. Not the 20-pager. It's a 1-pager. It's simply looking at your position and saying, how much of your wealth do you have in this taxable environment? How much in this tax deferred? And how much in this tax free? If you can see the percentages, you immediately will see the opportunity lies ahead of you to be able to be more tax efficient. If you'd like for us to produce that report, be happy to do it for you. Just schedule your 15-minute conversation and we can start there. I would tell you that's the journey of 1,000 miles, is understanding where you are today, and this report will help you see that and see the magnitude of your opportunity. Also, when we deliver this report, we'll start talking to you about all the potential strategies that's available for you. We'll walk you through and explain how that could work for you and what the impact could be if we were to help you through that process. So take advantage of lower tax brackets. Take advantage of this asset conversion review, which is going to come up here in a second for you. But let's preempt this. At the moment, our current income tax rates is not going to expire until 2025. If we were to transition money to a tax favorable place, I'm going to pick on the IRA. If we take the IRA, we transition it to a Roth. When should we do that? And let me explain to you the current window of opportunity that's available for you. You're under the current tax code situation. I want you to look at the brackets. If you were making, say, $200,000 of income at the moment, you can see that the first 80 to 170 is taxed at 22, and then the next portion is taxed at 24%. After 2026, when we revert back to the tax rates we were in before, I want you to look at this. You can see, but roughly that income is taxed at 25, and the next level of income is taxed at 28. Can you see the differences in rates? 25, 28 versus 22, 24. That's why we have a unique window of opportunity between now and the end of 2025 to have this discussion. I encourage you to look at that. Simply said, an example, if Dave and Sarah is making $170,000 of income, the tax bracket before 2017 was 28%. Today, 22%. Back in 2026, we're back to 28%. That just indicates unique opportunity for you 2021 to 2025. So what it comes down to is if I'm converting from the IRA to the Roth IRA, and there's two places you can convert to. You can go from the IRA 401k into the Roth. You can go from taxable accounts into the Roth as an example. The tax-free bucket is ideas like the Roth and the permanent insurance policies. You have to look at both of those two ideas and be able to look at the pros and the cons and see where that fits into your overall planning. But those are two of the buckets that money can go to. Where money can come from is your taxable environment or from your IRAs, which is your deferred environments. Simply said, we look at a number, and the number is the cost, the tax effective cost of transitioning from an IRA to a Roth. And we want to get that number as low as absolutely possible. There are unique strategies we use to be able to make that happen for you, to be able to drive the cost down. Year's a good deal in my opinion. If you can convert at rates of about 22% and lower effective, you are most probably going to find yourself in a position where that conversion could really save you some substantial taxes in the future. This is a simple slide that just shows you if you convert at the tax rates today versus what they were in the past, it's a substantial lower rate. So moving from IRA to tax-free is the most simplistic idea and version of it. It's a conversation we have every single day with our clients. It's a complex conversation because how you do this, it's not should you do this. It's how you ought to think about this, because there's many different forces we can put in play to be able to reduce that rate at which you're converting. I'm going to skip over an example. I'm going to fill in for you this way. In a perfect world, if you can convert during a period of time where the tax rates are low, they are stemming to be higher. They will be higher for one of two reasons. They either will expire in 2025 or they will be changed, most probably by tax code change, which I believe most probably will happen next year. This is your year, in my opinion, that you ought to really focus on, because I don't think our tax rates for a long while will be as low as it is today. But if you're going to convert at the lowest rate. And second, try to create offsetting income tax deductions in a big way in the year in which you are converting. That's a unique part of how we can help our clients today in what we are doing. We're creating large offsetting income tax deductions in the year in which you're converting. When you convert 100,000, 200,000, you create a taxable event. If you can create large deductions against that, you have the ability to be able to bring the total amount down that you will be subject to a tax. Simply said, you convert 200,000 and you create a $150,000 deduction, your net effect is only 50,000 more in taxable income. And then do it in a bracket in which your tax rate is low. So to take advantage of that opportunity, I have a second step that you can look at, and it's a report that we have available for you. This report is our asset conversion review. This is an opportunity for us to show you the impact of making this transition and what your tax rate would be or taxes would be in making this conversion, and how much taxes we'd be able to save, not just this year, but every year going forward. And that is important to weigh up. Is there a great savings for me in the future by going through this conversion opportunity this year? This is how this report looks like. It's pretty simple again. It's nothing super complicated. It's not 15 pages. It's easy to understand, and it's pretty vivid in the way that you'll be able to see it very clearly. If this is something that you would like, just click on that area for us right there that you would like to have further discussion. You can share your information with us and we'll be able to help you with creating this report. Finally, I would say this: what we all are moving towards is a smooth and a peace of mind and a fun and fulfilling retirement life that lies ahead for us. I will share with you that I'm having a tax conversation with you today, but a big part of what makes our firm very unique is that we are looking at the big picture from a comprehensive perspective. So nothing that I have, I can truly tell you, is the perfect investment, or no strategy should be done with only one thing in mind. When you have the big picture in mind, like your estate planning, your income, the risk and the growth that's inside of your accounts, the correlating investment strategy that needs to be in these tax vehicles, a very, very important part of our total discussion. Healthcare, should I ignore it or not? Area of long-term care discussions. These are all very, very important discussions, and how and the type of tax strategies you use is part of this big picture. So you ought to bring them together. When we look at, for instance, just your investment risk alone, it is very, very important that you think through that. It's another lens that we look at together with taxes. We tend to say to people in summary, it's about the plan, it's about the right tax strategies, and then it's about reducing the risk. And if we can reduce risk without lowering the performance, maybe even opportunities where we can increase the performance, and we can do it in a very cost-effective way, where the cost for your money management doesn't go up, maybe stays the same, even can come down, then we are utilizing all the cylinders that we have available for you. It comes down first and foremost to having a written plan, a written income plan, if you would. We call this our life wealth builder plan. This allows you to be able to see in detail a few things. How much income will you need on a yearly basis? Where will the income come from? Will there be enough checks for the rest of my life? And how can I coordinate my tax bill as well as my risk in alignment with that? And that, folks, is the secret sauce that we have in our firm. We start with planning, and from there we go into how we can help maximize you. But if you've never seen any idea of where your money is going to come from, or if you're not sure about having enough income coming in, I highly recommend you take advantage of this opportunity to have us do a written income plan for you. Again, we'll do a one-page summary for you, and to kind of get you an idea and starting the conversation, a visual of where your income is going to come from. The secret in reducing your risk lies right here. This is how we start with reducing your risk as well. So I'll end with some good comic relief for you. Will Rogers says the difference between the death and taxes is death doesn't get worse every time Congress meets. Isn't it the fact? I think Will Rogers was also the guy that says there's only two things certain in life: it's death and taxes. I guess that's why probably when I came to the United States, I spent a lot of time reading the Bible and the tax code. Two things certain: death and taxes. How can I use those two resources to help me plan for the future is a very important question, right? So let me put it all together for you. I'll summarize for you. There's really 4 opportunities for us to have a dialogue. If you just want to talk in general about how you can create more income tax deductions and what can happen for you this year as you plan next year, please let us know and sign up for our 50-minute conversation. If I can share with you more detail about understanding where your journey starts, but understanding how much money you have in these different areas of taxable, tax deferred, and tax free, you want to respond to that report. That's our tax diversification review. If I can show opportunity for you as to whether you should consider converting from an IRA to a Roth and what that might look like in this year, which I do believe represents a very unique year to do this in, then you just would ask us to do an asset conversion review for you. And if you've never seen where your income is going to come from for years to come, or still have a nagging issue or question around whether you have enough money, or you would like to see how you can reduce the risk in your portfolios, you would really want that written retirement income plan. Those are the opportunities that exist for you tonight. You simply just have to click on, again, the opportunity to take advantage. And there, again, on your screen is that link that you can click on. Whether you are sure or not sure about your future freedom in your retirement, and whether you are sure or not sure that you can use more of your capital to create unique experiences. And I'm here to let you know, planning allows you to have the freedom to do this. And I want you also to picture a day where you have the ability and the complete freedom to increase your traveling budget, It's probably one of the funnest things for me in planning, is to show people who have been used to growing their wealth, how they can increase their travel budgets, how they can increase the memories they built with their families by creating huge family reunions. I always say, go big on the family reunion time frame. You know, I was about a month and a half ago, I was in South Africa uh, burying my mother. And I remembered at age 74, her passing away from COVID, that I remember the trips. I remember the memories that we built together. And I was thankful that we took the resources, the capital to make that happen. And that comes through planning. I'm excited to share with you that we can help you with that as well. So I promised a final resource for you. And it is those good ones, those of you that remained here with us until the end. This is a free report, a free white paper that you can have access to. If you'd like this, just click on there, and we can send this and mail this to you so that you can read more about the topic I just discussed with you. I thank you so much for being with me tonight. We are excited to help in any way, shape, or form we can. And thank you again for your attendance this evening. Have a great rest of the evening, and we look forward to being with you soon again.